Hi, everyone. This is Mike Wilkerson, and this is the Stormwall Advisors monthly update for the month of March 2023. It's the first week of March. This is going up on YouTube. This is the forum where we talk about things that are going on in the economy, in the markets, and in the geopolitical situation around us. There's been a lot happening in the last few weeks, especially related to the economy. I want to jump right into it, but we're going to focus on two topics tonight. One is an update and perspective on inflation, and the other is to talk a little bit about what is going on in the crypto world, which I'm going to argue has relevance way beyond crypto in light of what we're seeing in terms of the recent government crackdown, Biden administration crackdown on the industry coming out of the FTX scandal last year. First, a couple thoughts as we come into March. This is the first week of March. Seeing a lot of very conflicting and potentially confusing data coming out of the economy. I talked at the end of the year that I made two sort of central predictions around 2023. One was that we had not seen the end of inflation, but that we were likely to see recession, the combination of the two potentially leading to stagflation. Certainly, as we're about to talk about, seeing some of the issues, some of the trends in inflation continuing in the way I had predicted and would have expected. But in the economy, we're seeing some mixed signals. Actually, things coming back a bit stronger, a bit hotter in job markets, labor markets, consumer demand, et cetera. I'm not going to get into that in a lot of detail, other than to say it actually leads to furthering the view that prices, wage prices, inflation generally is likely here and going to stay. So welcome aboard. We're going to try to move through this very quickly. And just as a by the way, if you're interested in getting a copy of this information, this presentation, you can always reach out to us here at Stormwall Advisors just by emailing hello@stormwalladvisors.com and just asking for a copy of the underlying presentation that we're about to go through. All right. So without further ado, let's jump into it. I'm going to share my screen here. Hopefully, I can do this appropriately. As mentioned, there we go, and you can reach us at stormwalladvisors.com. First piece I wanted to talk about is an update on inflation. So again, first week of March, we've got more information coming out in a couple of weeks. So this is data as of January. So we are seeing a continued slowdown from the peaks from last summer. January came in at 6.4, down from 6.5 in December, and down from 9.1 at the peak. I'd say the important points to note here is that while CPI inflation has been coming down for 7 months, January's reading is still well above the Fed target of 2%. There's definitely a danger if we start to get comfortable and accustomed to 6-7% inflation. Still too high, not great, especially if you think about over 2 years, that total CPI is up some 14-15%. When you look at what's happening underlying, it's pretty clear that both food and energy prices are continuing to rise faster than CPI. So if you look across the board, electricity up 12%, food at home 11.3%, fuel oil and utility gas, big ups 27% each, and transportation also up 16.4%. Where there's been some relief has been in gas prices at the pump, which have come down from highs last year. I want to zoom in and talk about one of those aspects, which is I mentioned food at home, the food at home index being up 11.3% year on year. And it's interesting because, again, I continue to believe that the CPI data is in some ways underrepresenting what consumers are experiencing, what Americans are experiencing here. Because if you look at a number of the most common items, eggs, butter, flour, soups, cereals, breads, rice, dairy, all those basic items are well above the index, offset by especially meats and proteins that have flattened recently, other more obscure things like condiments and that sort of thing. Now, eggs has been talked about quite a bit. There are specific issues here around the avian flu, bird flu, and rising demand. I mean, interestingly, there's been some trade down from meats into eggs up to this point. But things like butter and flour, again, this is a 1-year increase, basic essentials for all of the categories up over 20%. So this is something that I think is really, of course, affecting the American consumer and the pocketbook well beyond what these what the statistics are showing at an aggregate level. A lot of this is being driven by diesel. So we've talked in the past about the impact that diesel is having on the economy. If you look at going back to on the eve of pandemic and lockdowns in December 2019, diesel was $3.05 a gallon. It peaked in the summer at $5.75, up 88.5%. Still today, while it's come down off of those peaks quite a bit, it's still up over 44.5% during this pandemic period. That feeds into all food. So 70% of all foods carried on trucks across this country, at least, and that goes a long way to explain what's happening in food and in energy prices better. I think we've talked about, but I'll mention again that one of the main reasons for this is during the pandemic years, the U.S. cut its refinery capacity, assuming lower demand, decommissioned or shuttered some aging plants. So we are now at the lowest level of refinery capacity since 2014 at 17.9 million barrels per day. Matters a lot because this is what's causing the bottleneck on this issue. It's not that we don't have the minerals underground. It's not that we don't have the production capacity. It's getting it through this refinery bottleneck, and until that's addressed, we're likely to still see these issues going forward. Now, I've been pretty vocal recently that I think inflation is more than just the opening up of the economy. Look, there are some real supply chain issues. Certainly, China reopening is going to be a big factor. But I've also talked about the monetary issue, which is if you look at what's happened since the global financial crisis, the aggregate money supply, M2, has increased by threefold. We've gone from around $7 trillion to $21 trillion. And over time, price inflation will have to catch up with that money supply growth. Not dollar for dollar necessarily, but somewhere 60, 80, 100% of it. We've not seen anywhere near that kind of inflation yet. If you look at the amount of unrealized inflation, especially in the last couple of years, during the pandemic years, where there was this 40% increase in just 2 years in the money supply. And this is one of the main reasons, in addition to China reopening, which I think is a huge factor, but this underlying issue of money supply growth is something that is going to continue to drive price inflation through 2023. I've said recently in an interview with Kitco News that I wouldn't be surprised to see us return to that 8 to 10, even 12% CPI inflation range yet in 2023. Let's hope I'm wrong, but that's where we're putting it right now. The Fed has continued to raise rates and continue to use pretty hawkish language, Chairman Powell and others, that they are likely to continue. So right now, as of today, the target interest rate range is between 4.5% and 4.75%. The market is implying terminal expectations around 5.3% in July. But again, it does look like they are realizing that the economy is running a bit hotter than they would have hoped and are going to have to do something to address these issues. Let's turn the attention briefly to look at inflation in Europe. One of the things that's clear is while the U.S. led inflation up until a year ago, running at levels that were almost twice the amount of inflation in Europe, the war and in particular the sanctions imposed on Russia in Russia-Ukraine have reversed things. And since then, just a couple of months later, Europe's inflation has started to exceed the U.S., coming in at 10% for the European Union in January against a 6.4%. Like in the U.S., but on a more aggravated basis, energy prices are driving that inflation in Europe. They've come down to, let's say, 19% from an October's high of 41.5% year on year, but still at 19%, energy is the big driver for the Eurozone, Euro area altogether. But just as in the U.S., so is food and beverage, really pressing on European inflation. When you look at this on a country-by-country basis, it's pretty clear that countries that are or were dependent on Russian gas are faring much worse than the rest of Europe. Annual inflation rates in countries that are not dependent on gas, countries like Spain that has a lot of wind power, countries like France has a lot of nuclear, faring better. Countries like Germany 9%, Austria, Italy, that have a significant dependency on Russian gas, moving well above the European Union's average over the course of the last year. And interesting, you look at those European currencies and other currencies against the US dollar. The dollar had a particularly strong year over 2022. The one, or actually there are two outperformers versus the dollar amongst the major trading pairs was, interestingly, the Russian ruble, even though they too were experiencing inflation. It doesn't show it on this page, but at 11.9% on an annualized basis, a little bit higher than some of the worst outliers here. But a factor. On the other hand, the ruble has performed pretty well. That's a different story for a different day, but just wanted to point this out that in many ways, the US is exporting its inflation to Europe through the rising dollar, the strength against the European and other currencies. Now, I want to shift gears completely and go to something that may appear to be unrelated, which I call the crypto beatdown. Which, whether you're in crypto or not, bear with me because I think it has a relevance for more than that. So since the FTX fraud that broke in the second half of 2022, the Biden administration and the Federal Reserve, frankly, are using this moment, using that fraud as an opportunity to really come after the crypto market. I argue that the crypto industry's potential to disintermediate the traditional financial markets makes it a threat, not just to the banking sector, but also to governments, and thus a target. So just a few weeks ago, the Federal Reserve formally warned all of its member banks that holding, investing, transacting, basically doing anything in crypto is not permissible. These are not bankable assets. This is not banking activity. And at the same time, the regulators, the Federal Reserve, the FDIC, and the Office of the Comptroller of the Currency put out a joint statement warning banks about the liquidity risks of stable coins. I mean, even though we've seen liquidity risk in money markets and other places, particularly calling out stable coins as a potential risk. And probably the most visible implication has been the SEC, which has been targeting crypto through regulation by enforcement in the absence of legislation or congressional authority to do so. And in a somewhat related note, the U.S. Federal Court for the Southern District of New York determined recently that emojis themselves may count as financial advice, and in particular targeting crypto around that issue. The Securities and Exchange Commission under Chairman Gary Gensler have been in particular focusing on the issue. So a year ago, they announced that they were doubling the size of their enforcement operations for crypto and cyber units. And around that same time, they blocked the Grayscale Bitcoin Trust and others from creating ETFs. GBTC and others are now suing the SEC over this issue. We'll see how that comes out. But in the recent weeks, there's been a number of initiatives, enforcement actions taken by the SEC in the wake of FTX. So fining the Kraken crypto exchange $30 million related to their staking operations. Kraken's determined to discontinue their staking product in the U.S. markets. And they've taken enforcement action against Paxos, which was Binance, another big crypto exchange, against Paxos is their stablecoin issuer. And they also objected to Binance's acquisition of Voyager coming out of Chapter 11. And have come after several major crypto companies around issues with failing to register financial products as securities. Now, the SEC is not aligned on this. There are voices of dissent, and in particular, including SEC Commissioner Hester Pierce, who has repeatedly objected to Gensler's approach to crypto as a catch-22 for the industry. But nonetheless, in summary, I would argue that the SEC appears at this moment to be going nuclear on crypto. It has been commented on repeatedly. The Wells notices have been sent out to multiple individuals and crypto platforms in recent weeks, which Wells notice is basically a formal letter from the SEC saying that they've been looking at you and they're about to bring an action against them. And the SEC's jurisdiction is really around securities law and regulatory violations. So taking note, and the fundamental issue here for the crypto industry is, are they securities? What is a security? And pretty well-known test, which was the SEC versus W.J. Howey, which was a Florida orange grove farmers and marketers. And the Howey test simply says that a security, in summary, is an investment of money in a common enterprise with a reasonable expectation of profits to be derived from the efforts of others. So 4 tests: is there an investment of money? Is it a common enterprise? Is it likely, or is there a reasonable belief you're going to make some money off of this? And is it derived from the efforts of others? And I think it's pretty clear, if you look at this in the crypto world, that you can say that Bitcoin, on the one hand, is not a security. And in fact, the former SEC chair, Jay Clayton, said as much a couple of years back when he was still running the ranch. Ethereum is probably not security based on proof of stake and how their model has evolved, but it may be, at least according to Chairman Gensler. So we'll see how that breaks out. But on the other hand, using Howey and using the approach of what the SEC appears to be doing, it does look like many tokens from the wave of initial coin offerings in 2017, 2018 may indeed be securities. The real and underlying issue here, and my frustration with this, is the lack of clarity from the legislative branch in defining terms for stablecoins, for how crypto should engage, is causing a massive chilling effect on the industry. Why is that a problem? Well, the Federal Reserve has just blocked banks from participating in crypto by practicing regulation by enforcement and defining all tokens as securities, and at the same time waging a regulatory turf war with other regulators. It is having a couple of effects. The government's endgame here is to neutralize crypto on the path to establishing the US dollar's central bank issued digital currency, and to extend the future of fiat, and as part of a broader tightening of government control over financial transactions and the use of cash, which I've talked about pretty extensively. Now, there are upcoming hearings on this. The House Finance Subcommittee is looking at this and has basically labeled this as an attack on the digital ecosystem. This matters because if you think about what is likely to happen here, first of all, legislators need to legislate and provide clarity. That's not the job of regulators. Regulators are there to enforce laws, not engage in turf wars and power grabs. And the concern that I have primarily is if Gensler's SEC prevails and what they're setting out to do, crypto won't necessarily die, but it will be pushed offshore. This is bad for America. And it's worth noting that FTX was not a US-based platform to begin with. It was offshore already. The frauds that took place offshore. So on the one hand, they're going hard after US companies. Even Coinbase, the leading US-based exchange, has been talking about this. The CEO, Brian Armstrong, that concerns around SEC's approach, in particular regarding staking and other things, and making the argument that all this is going to do is push the industry, push these companies outside of the US. Why does that matter? Well, the US will lose its technical leadership and the innovation advantage it won in the 1980s and the 1990s in the tech and internet revolution if it strangles crypto, one of the most important developments in tech, in addition to AI and others, in this decade. So this matters not just for the narrow space of crypto, but really to all entrepreneurs and innovators. And it's a bit of a shot across the bow of entrepreneurship in this country. And I think it matters quite a bit where this is going to go. Well, let me wrap it up here. I'll just put this up on the screen. As mentioned, you can reach Stormwall Advisors at stormwalladvisors.com. If you'd like a copy of this presentation and the information in it, just shout out to hello@stormwalladvisors.com. Hopefully you found that information helpful. We're going to change up the topics every month and to try to provide some relevance. So if there's certain things that are on your mind as leaders in business, leaders in government, trying to make decisions around the issues that are going on in the economy, in the markets at large, let us know and we'll adapt to it. If this has been helpful, this is up on the YouTube platform, so obviously rules of YouTube apply. So like it, share it, subscribe to my YouTube channel, and we hope to see you again next time here on the Stormwall Advisors Monthly Update.